Hello, this is Joe Pryor, the virtual real estate team in Oklahoma. And what I would talk about today is how we're computing return on investment on real estate investment properties that's different now, say that it was 5 years ago or even 3 years ago. Obviously we're still in a pandemic state. We also have inflation going up considerably. That's disrupting supply chains. We know we have labor shortages. And so we're in this era where two things are going on in 2022. Number one, rates are going up, okay? We've seen it already. And so interest rates, if you're buying something on a 30-year mortgage, is going to affect your return on investment. Housing prices are going up more than we've seen in a long time. Now, Oklahoma City and Tulsa are unique in the respect that we've never been bubble markets. We've never been markets of high volatility, but what we're seeing is two very, very powerful economies going on right now. Population growth, people needing rentals, and inventory shortages in real estate, which is causing more and more people to rent, and those rents are going up. And so when we're computing return on investment 3 years ago or 5 years ago, and even 17 years ago, I've always preached positive cash flow, predictability, and that's important. But that cash flow is now going down just a bit. Inevitably, if your prices are going up on housing and your interest rates are going up, then obviously that affects your return on investment, that your cash flow is lower. But it's not the only thing that we determine a home's value to you for. Number one, if rents are going up, and they went up about 13% last year, then it's kind of helping that cash flow, doing a little bit of an offset, not a complete offset, but a bit of an offset. But the big thing that's going on is that appreciation was that high last year. And normally Oklahoma City and Tulsa are a guaranteed 3% per year market. I mean, rain or shine, from the year 2000 on, even in the bad time in the mortgage meltdown, this is what we saw. It was the most consistent state in housing pricing going up in the United States. But the economies in both markets are flying at this point. I said previously, we're down to 1.6% unemployment rate in Oklahoma City. That's unheard of. And so what's happening is now that appreciation that we put into that return on investment analysis, instead of being 3%, it's 5 or 6%, even though last year it was much higher, because we're trying to go out anywhere from 5 to 10 years when we're doing our analysis. Now, you've heard all about the miracle of compound interest. In other words, if you have something at $100,000 and it appreciates 3% per year, then next year it's 103%. But then when you compute it again, it's 3% based on the 103%, and on and on and on. That's the miracle of compound interest. So now when we're talking about 5 or 6% increase, then what we're talking about is at the end of that 7-year period, let's say you decide to sell that property, your wealth position is now higher. Now, certain things are lower, like cash on cash, the amount of cash that you're getting back. And so now we're seeing this change just a little bit. We're seeing cash flows going down a little bit, but this is what's going up in the appreciation. And at the end of that 7 years, the return on investment analysis is showing basically the same thing as it was 3 or 5 years ago. And so putting those two together, growth city, appreciation, this is what's making it still a good investment to buy today with these prices and these interest rates.